The most forgotten business in the world, Meta, just reported Q3 numbers this week, and this market once again showed us how they felt with an immediate 20% decline in the stock price. The business beat on revenues but missed earnings estimates, which have now fallen 4 quarters in a row. So despite being a conglomerate in the social media space, is this year-to-date decline of 70% warranted, or is this once again the irrational market behavior that us value investors love to profit off of? We'll answer all those questions on today's episode and more. How's it going? Welcome to Anything Investing. I hope you're having a great day. In today's video, we'll start with the full analysis of the financials, top line, bottom line, balance sheet, etc. And we'll conclude with an evaluation of this business to see whether or not Meta really is a value investment or not. And if you enjoy this type of content, please subscribe because we post on here regularly, looking in depth on the fundamentals of different businesses to see where the current investing opportunities are. So if that interests you, please leave a like and subscribe. But without further ado, let's jump into the video. All right, and as always, we will start with the comments from the CEO for this quarter. And according to Zuckerberg, the community continues to grow. He's pleased with the strong engagement they've seen, which is driven by progress in products like the Reels, and that despite near-term challenges on revenue, the fundamentals are there for a return to stronger revenue growth in the future, and they're focused on prioritization and efficiency. All right, so historically, we've been able to see that they have been able to grow the revenues year over year over year. Great to see from any business. Bottom line has actually followed that trend for the most part, besides a small slowdown here in 2019. And so you always have to wonder, if the stock is down 70% year to date, but the revenues and bottom line are growing at these high rates, where's the discrepancy? What's going on? We have to take a deeper look. All right, in order to do that, let's take a look at their segment results. We can see here they were able to produce $27 billion of revenue. That consisted of revenue from their apps of $27.4 billion and their Reality Labs revenue of $285 million. If we compare that on a historical basis, Reality Labs revenue has been declining, and that is not great, as they're really looking to grow this in the future. Their family of apps revenue has also been consistently trending in and around that $27 to $28 billion range, and so we're not seeing any growth here, at least for the last year or so. And since Meta is a growth stock, like we always mention on this channel, as soon as the growth stops with any growth stocks, the stock gets slashed despite anything else that they have going for them. All right, and after all their costs and expenses, they're left with operating income here of $5.6 billion. Again, looking at this historically, last quarter we had $8.3 billion, the quarter before that 8.5, the quarter before that $12.5 billion. So we've seen a significant decline again here in operating income. This is another issue that they're currently facing, and another reason why people are dumping this stock hand over fist. Finally, one of the nails in the coffin here is their operating margin, as it's absolutely deteriorated from 46% back in Q4 of 2020 down to 20% now in Q3 of 2022. So they're having to spend more and more and able to produce the exact same amount of revenues. Yeah, this is a big problem for Meta. But if we look at the income statement here, we can really see what's actually driving their costs up. And mainly that is research and development, marketing, sales, and general and admin. All right, and this becomes even more clear when we look at this from a 9 months ended perspective. Okay, these are up to $25.5 billion from $17 billion, a year ago. Marketing and sales up to 10.6, and then G&A is up to 8.7. Again, total costs and expenses are increasing rapidly while revenues are just staying stagnant. All right, and when we look at this from a net income perspective, yeah, we're left with $4.3 billion in net income. Last year, $9.1 billion. Yeah, it's easy to see why this stock is down 70%, seeing as it is a growth stock as well. When we look at their main segment here, advertising revenue, it was historically used to growing, and for the past 4 quarters or so, that's been declining globally. Expenses as a percentage of revenue have been growing consistently. Net income for the past 2 years declining, so something's definitely wrong here. But let's look at the flip side. It turns out daily active people using their apps has actually increased from 2.5 billion people up to now $2.9 billion as of this quarter. Average revenue per person has actually stayed relatively the same. And according to Zuckerberg, there are now more than 140 billion Reel plays across Facebook and Instagram each and every single day, which is an increase of 50% from the 6 months ago, and has really helped with their time spent on their apps. And they're saying that they're actually gaining market share on competitors like TikTok, and that they're actually able to monetize this to the point where they've now reached an annual run rate of $3 billion across Facebook and Instagram. So despite the fact that fundamentals are not looking that amazing, we do have some sections of this business that are actually growing. And ultimately that brings me back to their expenses, okay? What's really taking up most of the costs here, right? It's the research and development. They're really pushing for the metaverse business, as they see there's a great opportunity there to really lead the way in AR, just as they did with Facebook way back when. So if these research and development costs actually start to shrink as the Reality Lab segment starts to gain a foothold, fundamentals are going going to improve, this business might actually start to function again with growing revenues and earnings. Now let's take a quick look at the balance sheet. We can see $42 billion of cash, $10 billion of debt. So the balance sheet looks clean. Now let's look at what they're doing with the free cash flow. This quarter, we had $9.6 billion cash from operations, CapEx of $9.4 billion, let's call it $9.5 billion. So they're only left with $173 million in free cash flow. Just another reason why investors in Wall Street have just dumped this stock. Free cash flow looks terrible here. What do they do with that cash flow? Well, besides taxes, they're actually repurchasing shares and taking on some more debt. All right, so I have no harps about repurchasing shares while we are at historical lows. I mean, we haven't been back down to these lows since like 2016. So this is a great place to buy shares and use the cash that they have on the balance sheet to do so. And they are taking on debt because they are in need of some cash here. They're not able to produce as much in terms of free cash flow. So I don't blame them at all for doing that. But with all that being said, this takes us to our intrinsic value calculator. What numbers are we going to put in here? And well, we need to look at this from a historical perspective because they have had a bad quarter. You know, we need to come in here and estimate what the future of this business is going to look like. And the best way to do that really is to look at their historical performance. As we can see here, operating income has been growing year over year on a relative basis, even up until 2021. But if we expect that on an average basis, with the declines they've had in fundamentals and increases in expenses in research and development and such, that they can produce about, let's call it $25 billion in operating income going forward, then when we plug that into our calculator, if we require a 10% return, they do not currently pay a dividend, that if this business over the next 5 years can grow at about 7%, then that drops down to about 4% on a 20 PE. This stock should be trading at about $152 per share. Okay, we're currently trading at about $99 per share. Now, in the best case scenario, historically, they were able to grow their EPS numbers at about 31% per year. Now, that is including some buybacks. So let's just say they're able to grow at 15% off the back of a rebound in the economy, further growth in the Reality Lab segments, and increases to the revenues from Reels. In that for the 5 to 10 years after that, they can only grow at, let's just call it 9%. On a 25 PE, this stock would be worth $329 a share. Is this crazy for the stock? No, we've been there before many times, and this is an average estimate of about $25 billion just in operating income. Now, in the very worst case scenario, let's assume Reels doesn't really take off anywhere. We see further declines in their fundamentals, expenses continue to grow, revenues slow down, etc. Their growth rate is actually negative 5% for the first 5 years. Then for the 5-10 years after that, let's just say they normalize at a constant rate at 0%. On a 15 PE, this stock would be worth $53 per share or $123 billion in market cap, which is basically a 50% decline from where they are right now, seeing as they're at about $100 per share. Now, with all that being said, they're trading at a PE of 8, a price to sales of 2, a price to book of 2, and a price to free cash flow ratio of about 7 on an annual basis, which makes this stock incredibly cheap, especially for the conglomerate that they are with the market share that they have. And I mean, how much lower is this stock really going to go? They're going through a very tough time, and yet they're still able to grow their monthly and daily active users. But ultimately, the investment thesis goes as follows. If you believe there's going to be further hardships for Meta in the future, they're going to have to spend more on research and development, daily active users, monthly active users will decline, ad revenue starts to decline, etc., then yes, we should dump this stock as well, and the 70% decline is warranted. However, if you believe this is a low point for Meta, that they will return to revenue and EBITDA growth in the future, that once we see an economic rebound, that this stock will also benefit from that, and that they'll actually be able to increase their ad revenue and shorten the amount of expenses that they have, then this might actually be the best buying opportunity there is. That's not to mention any of the AR/metaverse revenues that they're looking to propel this business higher with, because I would agree that that is, probably 5 to 10 years away still, but that's just another benefit if you were to invest in the stock. But with all that said, let me know your comments down below and let me know what you think of Meta. Are you a buyer? Are you a seller? Or are you completely hands off? And if you enjoyed this video, leave a like, subscribe, and I'll catch you on the next one.